Good afternoon, tech traders. Today is the 7th of May, 2023. It is a Sunday afternoon and looking at a trade for the week. And so I thought I'd share this analysis with you and see if we might find our trade for the week and find something profitable happening in the marketplace. This, what you're looking at here, is the results from Friday. Friday was a big up day. You can see every sector was up on Friday, and some sectors up well over 2%, which was a very positive day. And what that's done is that's turned the VIX term structure into contango, smoothed it out a little bit, and given us a nice smooth contango feel to the VIX term structure, which is bullish for the marketplace. There's still a little bit of uncertainty out there in the market, of course, with all the bank failures and everything that's happening in the world right now. You can't help but feel a little uneasy that maybe the market has a little bit of a sell in May and go away mentality coming. Who knows? But at least what the data is telling us right now is things feel pretty bullish. So let's look at what we might see happening this week. I'm going to start by, here's our watch list, and I'm actually going to filter our watch list by earnings date. And I'm going to remove the zeros here. So these are shares that have earnings coming up in the next day or 2 days or 3 days, 4 or 5 days. You can see it listed here, right under here. And see what might be happening. See if there's anything out there that looks interesting to trade. Now, I have been making some good advancements, making some good trades in the IT sector. And one of the things that jumped out at me over the past couple of days was this WDC, which is Western Digital. And Western Digital is something that I've traded before, traded successfully before. It looks to be trading about $33 a share right now. I don't have any shares of Western Digital, but I have traded it. We've got 3 million shares changing hands on Friday, so there's significant trade activity. Look at that vol. It's elevated implied vol, 60% vol, and that could be a trade that would be of interest today. So let's go over and analyze that a little bit. Here's WDC already pulled up on our trading package, and we're looking at the June 23rd options, and I started right about at the money, 32.5, and going outwards, and then same thing with the puts, starting at 32.5 and going down. These red flags here are indications of the bid-ask spread getting a little wide. That's because we're sitting here on a Sunday afternoon doing this analysis. Those will probably tighten up a little bit as we get into the marketplace. Some other things that we notice, the recent price history down here in the lower left-hand corner. You can see the price has fallen below the 200-day moving average and the 50-day moving average. In fact, we had a crossover of the 50-day coming down, crossing over the 200-day. That is a bearish sign, at least if you're a technician of the marketplace, that's bearish. So we've got some mixed signals here on the marketplace. You can see over on the left-hand corner, we've got the VIX right now at 17, which is a historically low level. The VVIX under 100 at 91. These are both very bullish for the market. It's not showing a lot of fear. Now, there is a little skew in the marketplace, meaning the out-of-the-money puts are selling for a premium. I think that's people just being a little bit careful and buying some protections out of the money. So that skew is slightly elevated. Now, here are the here are the red flags for WDC, meaning that it's trading below its 50-day moving average and its 200-day moving average. Now, the VIX term structure is in contango, which is bullish for stocks. And you can see, however, there's not a great correlation when you look at the beta for WDC, 1.76. So it's a lot more volatile than the marketplace. Not a huge correlation with SPX. So the fact that we're in contango here doesn't necessarily make me feel all that great about being bullish on WDC. So, but here's what we're really trading. We are trading the historic vol being well below the implied month, the front month implied month vol. You can see it's at 57% and historic vol is at 45. That is because of the earnings. So we are coming into our earnings period here, which is right here. That is that's driving the vol up. Here's the vol tick up. That change in color here indicates that we've got a vol tick up, and there may be some trading edge in the difference between here. So the edge that we're actually trading here is what they call the variance premium, and we are thinking that this front month implied vol might be a little bit overcooked, and it might be a little bit excessive, and that the realized vol might not be quite as bad. So we're going to see if we can analyze a trade here. I think what I'd like to be on this trade is more delta neutral. I don't have a very strong opinion about the direction of WDC. You can see here it's been fairly flat, flat to overall trending down. I don't feel strongly one way or another on this, so I'm gonna look to play this as a neutral trade. So let's get started. Let's see if we can build a trade. So we'll come over our Trade Builder tab. I am trading the June options, so I look to be out of this trade probably the first Friday of June, and then now where do we start? Now we saw that there was a good put skew back here. This was a kind of a normal put skew, 22.5% put skew, meaning that the risk is to the downside. And that is usually a very good thing for selling options, particularly put options down here. What's interesting here is take a look at the call surface of this diagram of the call surface, and you can see it's got quite a smile going on, which meaning that the out-of-the-money calls also seem to be trading at a little bit of a premium here. So it could be interesting, and if I'm going to try to place a delta neutral trade, I'm going to want probably a trade on the upper end on the calls as well as down below the market with the puts. So let's start off, and let's just say if my expected value, I recenter my chart, my expected value, expected move is going to be around 27. I'm going to look to go outside of that first standard deviation and see what sort of value I can get out of these. So I am going to select the 25s, and I am going to see if there's expected value and sell one of those contracts. There is the short put, and yes, indeed, I've got a high probability of profit. There is trade expectancy in there. I've got a nice payout ratio. Not a fantastic return on capital, but a good return on risk. Sharp ratio, which I usually like to see above 1 for a trade, is flashing red at me. And I could take a lot more of these. If I did decide to do this trade, I could take a lot more of them. So it says I could take 7.5 times that with the portfolio that I'm trading. So I tell you what, let's not do one contract of that. Let's do 5 and see what that does. So if I take 5, still have the same probability of profit, just larger. I'm looking at a $122 credit. Good payout ratio. Again, having a tough time with return on capital and the Sharpe ratio, but let's see if we can mess around with that a little bit. And now that looks about appropriately sized for the account that I'm trading. Now I mentioned I wouldn't mind going up on the call side. Take a look over here at the Greek sensitivity profile, and you can see that I am 35 deltas here. I've got 35 positive deltas. And I had made the comment earlier that I'm really not all that interested in taking a delta position on this. I don't feel particularly bullish, although if this stock did get down to 25, I might become bullish on it. But for this trade purpose, I don't think I want to carry 35, have my lead Greek here be the 35 positive deltas. So I'm going to balance that out with some call spreads. And the purpose of doing that is bringing that delta down. I'd like this trade to be driven more by Vega than it is by delta. And so right now my delta to theta ratio here is 5. My Vega to theta ratio is 1.3. I want to bring these deltas down, and I want to increase the Vega, increase the vol. So let's sell a couple of call spreads up here. I'm thinking about the 32.5. 35 call spreads. So if I sell, say, one of those call spreads, you can see now I've got a pretty good trade metric here. I've got an 88% probability of profit, good expectancy, very good payout ratios, great return on risk, and my Sharpe ratio is 1.1, which that's why that's turned green. And so now this is becoming a pretty good trade. It says I can take a couple more of these. So let's see, instead of selling one contract up there, if I sell two verticals. So if I sell two verticals here, you can see what will happen. Look at that. I've got now the Sharpe ratio up at 2.3 with still a very good probability of profit, great payout ratios. Everything is looking pretty good. So I like that Sharpe ratio of 2.3. Now, is there an optimum level? Can I keep going and just selling a few more of these calls? What if I were to sell 3? Keep an eye on your Sharpe ratio here, 2.3. What if I were to sell 3 contracts up there? And what that would do is that would lower the Sharpe ratio back down. So I have hit an optimal number of call contracts on that higher end at 2. So I'm going to do 2 contracts here, and that looks like a very, very good trade. I like the numbers on that. Good probability of profit, very good payout ratio. I'd be collecting $375 of income. My Vega to Theta ratio is well below 3. Look at what happened to my deltas. Now I've only got a slightly negative delta. Call it delta neutral. And really my lead Greeks are going to be the gamma and the Vega risk. And this short Vega position is what we are trading for when we talk about the difference between this front month implied vol and the historical vol. This is all going to come crushing out in 2 days when they make their trade announcements or make their earnings announcements. So that vol crush is what we're playing for here when we have this short Vega position. And I have achieved my desire not to really take a stand on whether this thing is going up or down. So this is a fairly neutral trade with a very short, small amount of short deltas on here. So well-balanced trade. I am looking to be out of this thing in under 26 days. I have a feeling it will be sooner than that, which will help this expected return on capital because I'll be out of this trade a little faster probably than I've got here on the 2nd of June. So very strong trade here, which is 5 short 25 puts. The 25 puts, I'm going to short 5 contracts, and then I'm also going to sell a couple of out of the money. Sorry, those are in the money. A couple of call verticals here. The 32-35. That's a 1 strike in the money, 1 strike out of the money. Short call spread, and I'd be looking to sell 2 of those. And in doing that, I'd be collecting $375. I'd be looking to pull out about $250 out of this trade when it's all said and done. So anywhere around $200 to $250, and I'd be risking, at least within this time frame, over 2 standard deviations, I'd be risking only about 150, which is why we're getting this this great payout ratio here of 275%. So I hope you found this trade helpful. This is something that I plan on putting on. I will likely publish the video after I put this trade on, except to the tech traders who know what I'm doing before I actually put the trades on, because actually I wouldn't want this trade to get too crowded. So I will post this trade. We'll see how it goes after earnings, at which point I'll record a video and see if we need to make any adjustments to this trade, or if we just close it out and hopefully find ourselves in a profit position by the end of the week. But I will check back in and let you know the outcome. Thanks for paying attention, and we'll talk to you soon.